Okay. Hi guys, my name is Nishanth. I work at a place called Dwara Research, and I predominantly do policy research, which deals with financial systems design. So my topic here is to talk about payments regulation and review what has happened over the year. And before we sort of get into what I do and sort of going back into this topic, I just want to show you two pictures. And given that most of you work in this space, these aren't going to be complete news to you, but it's still something that we would like to sort of see is in the space of retail electronic payments, we've seen that volume of payments over the year, and given the starting with of the year from demonetization in 2016, we've seen several policy pushes towards increasing retail electronic payments, right? So to just take a look at what has happened over the year in terms of participation, we've seen that there is 11% growth in volumes of all electronic payments. And that is in general a good thing, because over the last year, starting from demonetization and several other policy efforts, as well as expansion in the market quite heavily, we've seen growth in terms of all sort of payments modes. And this growth is sort of typified by the fact that UPI, USSD, and other small value, typically transaction modes which are for small value transactions, you've seen immense growth in that, and which could in some sense say that yes, there has been sustained growth in participation in these retail electronic payment modes, right? And yet this is a nice picture that came out as part of a live mint piece in November 2017. Sorry about that, but which basically tells you, if you were to look at ATM withdrawals, or the amount of cash is still being the most preferred use in terms of payment, right? So you've seen the level of ATM withdrawals have come back up to pre-demonetization levels, and this graph shows you, and if you sort of look at the green line here, right, it sort of gives you the ratio to the amount of ATM withdrawals over narrow money, or M1. M1 is typically this financial term that's used for anything that is cash or cash-like modes of payment, which is just demand deposits in your bank account plus currency in circulation, right? So if you see that, it's very interesting that it comes back up almost to the levels of what it was in early 2016 or 2015, and which would beg the question of whether or not we have in some sense become a less cash economy. Have we started truly adopted as an economy, in like the most macro term possible, the macro sense possible, have we truly adopted to actually transacting in more retail electronic payment modes, right? And this is sort of where we wanted to analyze over the year. There have been various, of course, like the presentation before, which talked about Bharat QR, there's been a lot of industry-led efforts. There's a lot of market infrastructure that's being built, but then there's also been a lot of policy changes that has been made in order to sort of incentivize this move towards having more digital payments in general. And that's sort of what I'm going to talk about, which is what is the role of regulation or policy in this space, and how has it affected over the year. And I'm probably cheated a little bit in sort of showing you what it hasn't achieved already in this year, but that not necessarily means that I would want to go through what those changes are and sort of see if some of these might have a latent effect, and some of these might have an effect in the future, and maybe we can sort of gauge whether there are, at least in terms of regulation and policy, are they moving towards in the right direction, right? So sort of before I quickly get into what the exact policy changes were, we sort of want to discuss what is the role of regulation in this. And here we want to talk about a little bit about RBI, right? RBI is the principal regulator in this sort of space, and then in terms of a first principles context, you would assume that the role of the regulator here is to maintain certain core principles. There are certain non-negotiables that comes when you're talking about payments and payments regulation, purely because of the importance of the function that it offers. In a design perspective, given that we look at financial systems design, from a design perspective, you look at it, payments is usually like the pipelining towards the entire financial system. So whether or not whoever the institutions are, how I connect every transaction between financial institutions, between consumers and businesses, between business and institutions, are connected through different modes of payment. And typically we've seen over the last few years, this is last few decades, this has become largely electronic, right? So this is a very much an important space for the regulator. And the core principles that the regulator would typically look at is financial stability, consumer protection, market conduct, anti-money laundering, and institution neutrality. And this is pretty much like as broad as they are, right? So the way you would want to influence or maintain these principles is through sort of regular policy checks and regulation. And this is again from a first principles context, not necessarily saying the regulator is doing all that, but from a first principles context. And although like typically, at least in the market, it's usually we think of regulation as rule setting and enforcement, right? So if we sort of step back and look at what RBI has done over the years, at least the intention towards has been the development of the payment space. And this is in some sense a little too much interest in the fact that they've started releasing visions for their payment systems and payment system regulation since the end of since the late 90s, right? So RBI puts out on a regular basis vision documents which talk about what they plan to have done in the next few years in terms of policy and regulation, and how to better create an atmosphere for payments, right? So the Vision 2018 statement says they wanted to build more less cash India by influencing the payment systems, payment settlement systems through robust regulation, through responsive regulation, robust infrastructure, and effective supervision and customer centricity, right? So these are all things that you would typically see in any sort of vision statement, all broad statements that have been made. But if you take a step back and look at it, it's actually a good thing given that the interest is there in sort of developing the market, right? And this is something that it's often seen as the mandate of a regulator is to also look at the development of an emerging market, especially if it is of primal importance to the system. And they do this typically, like there is a lot of often regulators and policymakers like their 5Cs, their 3Cs, and all that sort of a framework. But what they do put out in their vision statement is to have better coverage, convenience, confidence, which was an important aspect that we touched upon even in the last presentation. Convergence in terms of making sure all policy, all institutions that perform these functions are at par or almost at the right scale, having a level playing field, and most importantly, cost, right? So as a regulator, you do have control over certain cost functions that you can handle, and typically what we've seen with the MDR, for example, is a typical example of how RBI is trying to sort of subsidize costs in order to promote the market, which is necessarily comes from its own mandate of developing the space for digital payments, right? So this is sort of something that I wanted to do before starting to look at exact regulations, which is to just put this idea of there is a regulator who's looking at enforcement and setting rules of making sure that the system doesn't crash. And on the other side, you have also this role of developing the market as much as possible. We could debate about the efficacy of these developments, efficacy of these policy transmissions, whether or not they're even doing the right thing or whether or not they're inhibiting growth, innovation, all that. But in a broad sense, there is this mandate to do this. So now typically coming to what has changed this year, right? So there's been, since demonetization, and even before that, we've seen a lot of government as well as regulator pushes towards sort of enabling this space. And it's almost really surreal, because if you see the number of departments in the government as well as the RBI thinking about regulating, let's say something like PPIs, it's immense. So you had MeitY, which was the Ministry of Electronic Information Technology, and you had RBI coming out with rules for PPIs, which you had not seen so much interest in this space. So what I'm trying to say this is that the fact that there has been so many institutions involved in sort of trying to influence policy just shows the amount of interest there has been. And if I tied back to a lot of things that have happened over the year has been more or less being influenced by the Watal Committee on digital payments which was constituted in 2016, right? So they came out with medium-term recommendations on how to strengthen the digital payments ecosystem. And my colleague Malvika, I think, had a session last year on this, where she sort of broke down all of the recommendations made by the committee. I'm not going to go through all of them, but some of the important changes that have happened can be clubbed, and the recommendations as well, can be clubbed under 4 big buckets. And if you look at these buckets, they would have been, one has been the need or the requirement to have an independent payments regulator, which is not the RBI. And there have been certain, I will come to that in more detail, but that's been a big sort of discussion point um, across the regulatory space, as well as in the media, as well as in the market, whether or not there is some bias with the fact that RBI does control and operate the payment systems, as well as regulate payment service providers. And maybe that is a good point to raise, because that might bring out the need for an independent payments regulator. The other sort of interesting recommendation which came out was the interoperability. And we have definitely seen some movement on this. Again, I'll just talk about that in a little more detail, to make sure that both from a consumer and a service provider frame of reference, you have interoperability between all payment service providers, including banks and non-banks, right? So that was a big recommendation that came out, and which again was talked about a lot over the year. And and then there was a few on promoting digital payments and disincentivizing cash in general. Again, a lot of these have these were really small recommendations, which were easy to implement, I would suppose. And there has been, and they've taken different forms and shapes. Whereas, and in general, that's something that's continuously happening even without the Watal Committee. We've seen that happen over the years. You've had additional charges on ATM withdrawals, for example. You've had charges for you to transact out of your digital wallet into a bank account. So these sort of disincentives have already existed, but then we have seen some more of that, and I'll talk about it. And finally, it's about ensuring consumer protection and data protection. This is something that we've not seen as much movement as in this year as we would have liked to see, because this is a thoroughly important space. And again, there has been a committee that's been constituted to look at this, and generally data protection in a larger sense, or not just finance, but also in other sectors. So that's something we hope to cover as well. So the idea was that these are the big recommendations made by the committee, as well as a lot of changes that we see in the market can be bucketed under these. So coming to the first one, it was the case that, like I said, the Watal Committee had looked at the fact that RBI was performing both these functions of being an operator as well as a regulator, and maybe it would be more prudent to have, and it would also increase competition if we had an independent payments regulatory board. And to do this independent body, they had two kind of structures that they looked at. One was completely isolated regulators, which was RBI, and iPay, which was one structure that they did look at. And the other one, which has been sort of adopted, has been with having an independent committee within the RBI. And that's something that's happened now. The Payments and Settlements Act has been amended to create this special independent body, Payments Regulatory Board within the RBI. And there have been questions on whether or not, and what are the functions of these, what are their main mandates, and what is going to happen in terms of how are they planning to make this make it a level playing field for all payment service providers. What are the general mandates that they would have? And that's sort of unclear, but what has been clear in some sense has been the fact that the RBI welcomed this move when it did happen, and said that it would work much like the Monetary Policy Committee. The Monetary Policy Committee is, for those who might not know, is a committee within the RBI, which is predominantly and very specially equipped to handle the changing of interest rates. While the considerations on interest rates has been considered by the MPC, the regulator is still the RBI, which then imposes all the rules that have come up from the MPC. So they do sort of envision the PRB to perform in a similar manner. Again, there can be questions about the efficacy of this process, can be questions about how effective this will be in sort of allaying concerns about having a more level playing field, as well as creating a little bit more competition in the space between banks and non-banks, for example, because there is the current narrative is the fact that, and that might be true in a large sense, is payments is pretty much a bank-led sort of industry, and non-banks are pretty much catching up at most points of time because there is an imbalance in terms of function and power. This is one big recommendation that did come through, and maybe something to also sort of look at in terms of what's going to happen in the future. The other big thing which I did touch upon earlier was the whole idea of interoperability, right? So in October, for whoever was already in the industry, you might already know, and in October we had this whole new guidelines for PPIs that were issued, and this sort of allude to the fact that you will have partial interoperability in the beginning, meaning that consumers who have access to money stored in wallet A and wallet B can now transact between those wallets without having to go through their bank account. And those in general, in a larger scheme of things, seem to be something in the right direction, given the fact that they also promised that you would have interoperability with banks. Wallets and banks will also be now interoperable in the future, and this is something that that's something that came out of the recommendations, and also something that market and industry participants that we'd spoken to had said that would be absolutely necessary if we were to sort of compete in the larger market. The picture that I wanted to show you, and again Madhu had probably a better picture, which was similar in sort of showing you how these transactions happen, and the fact that even if interoperability is now enforced, there is some concern of whether or not they would still have to go through the banking system. One of the Watal Committee recommendations was the access to RTGS, which is the bank's payment network, is how they would transact with each other at a real time. But that's probably not something that we don't have enough clarity about, but doesn't seem to be in operation. But it is the case that now you would have partial interoperability through UPI, and that's something that's quite interesting to see how it picks up. I know there's been a lot of concerns within the industry about the deadlines that have been set up. I remember that compliance was required before the 31st of December, and there was a lot of running around to get that done. What also came out in the guidelines, interestingly, was a full KYC requirement. And this again is something that could be seen as both positive in the long run, but a really and almost a deterrent in the short run for the mobilization of digital payments, especially through wallets, right? Why this was the case is that earlier, if you had stored amounts and transacted with it, lesser than 10,000 rupees through your wallet, you didn't have to do KYC. And now it is the case that almost all wallet providers are supposed to get complete KYC done for all their customers within 12 months of them having logged in, or since they start using those wallets. Sorry, and that comes at a cost, because that increases a lot of operational costs for the wallet as well. But and in some sense it can be rationalized over the longer term, but that's something that happened, and we don't know if that we haven't really seen the effect of how much interoperability will now impact in terms of growth of digital payments yet. But this is one of the largest things that I would say that happened in the policy space. But not to get too much into the details, but then I just wanted to show you a little bit about why and to rationalize some of these changes is often, if you look at function versus regulation, and you see this across the entire financial system, is that you have different hierarchy of financial service providers, and then have graded regulations for them based on their function. So if, for example, if you were to take the payment space, you have functions such as cash out, having, in some sense, using the value that is stored by the customer with you, and also interoperability, right? So if you look at the PPI, for example, when post this whole change in the guidelines, you now have partial interoperability, but it does come with a full KYC requirement. So this, you can somewhat see this as a sense of harmonization to what would happen with that of a payments bank, right? So payments bank had similar sort of, if you see now that they also have a 1 lakh transaction limit that can be stored, and they also require a full KYC. So if you see, the whole idea is that once there is some sense of the industry has grown large enough, or the particular type of institution has grown large enough, that you can start rationalizing and moving towards the larger setup of what regulations should be, for example, for a bank. And this is again, and to give you a little bit more context, is that why a PPA would not have a cash out facility available, or will have highly restricted use of funds that has been stored with them, can be sort of compared with that of a bank, which has cash out as well as almost complete good use of the funds that are stored with them. Comes with liquidity and capital regulations. Comes with the fact that now, if I am someone who stored money with a bank, the bank has to sort of put them in sort of SLR, or sort of purely liquid instruments that they can make sure that the money is not completely lost. In the PPA setup, you have an escrow arrangement to make sure that funds are used in the right way, and whatever. That could be restrictive, it could not be optimal, but the function there is to make sure that the function overall in both senses is to make sure the funds are kept safe, and also there is liquidity for a customer to pull out cash whenever they want, and there is no sort of crisis that the bank has. But sort of coming back, but just wanted to show this only to sort of say that moves like these might not be completely rational, but can be some things that cannot be looked at independently, and sort of you have to look at what does that mean when I look at harmonization, as in, to a larger extent. Don't want to stress too much about the other two, but then in terms of promoting digital payments and disincentivizing cash usage, something that even Madhu had sort of alluded to was the MDR. The Watal Committee, interestingly, had said the MDR was in general a nice move in terms of promoting merchants to start accepting digital payments. The reduction in MDR and the whole regime. But what they did say that in the long run, MDR is something that should be set by the market. In the long run, it doesn't make sense to regulate MDR purely on a functional level. What they should be doing is probably regulating the interchange fee, which is the fee between the issuing and the acquiring bank, and not the MDR, and not the rate that, or the fees that is set between the merchant and the bank. And this is something that they did say. But if you see regulations that or the guidelines that came in December, almost a month or month and a half ago, MDR was RBI went in the opposite direction and sort of reduced MDR to now have a component which would be dependent on the size of the merchant. So if there's a merchant whose turnover is less than 20 lakhs, then you would had then and for transactions that are more than 2,000 rupees, then you had a reduction in the MDR costs that would, if you would to compare them with a larger merchant. And this RBI's rationalization here was to, now I can have more merchants because they feel that the MDR is so low that they would start adopting digital more. And if there are people who have a larger customer base and sort of serve a different sort of customer segment, which is not that does not have typically access to merchants that do digital transactions, this would be in some sense sort of enabling, sort of both from a merchant side as well as from a customer side, because as they see that, oh, smaller merchants are accepting, they would also be more willing to pay digitally. But then again, this is something that is worth a good days of debate, because we don't know how the larger sort of implications of having such MDR, and we don't know whether this would be the case if over time RBI realizes that they would slowly take, stop this capping of MDR. Then we don't know whether there will be a sustenance in terms of participation in digital payments. Right now, on the short term, it looks good. Again, we haven't seen the the sort of numbers that go with it. And that's one thing that sort of should point out. Finally, on the ensuring customer protection and data protection bit, like I already said, there's the Sri Krishna committee that's going on. My colleague Beni, I think, should be in the afternoon, and she sort of worked a lot on sort of providing recommendations to the committee on the payment side. So that could be something that anybody is interested could talk to her about. On the customer protection side, there's something that has been sort of mixing in lately has been the idea of limited liability. Now RBI has enforced a regime of limited liability on banks. Is that now based on whether or not a customer has reported an unauthorized transaction? So if you are a customer and you have an unauthorized transaction and you report it within 3 days, the entire onus or the liability falls on the bank. Whether and the longer it goes, there would be some amount of liability that the customer takes. So this sort of limited liability framework has been put into place, which is now taking away the onus completely from the customer to have done, to have reported, to have it is their responsibility to claim any money that has been lost through unauthorized transactions. And that sort of regime has been taken over, and this move towards limited liability seems to be a good move towards in terms of customer protection. But we haven't seen that in some sense for the non-bank players, which is essentially could be something that could be in the range, and that could ensure that there is a lot more that there is some amount of consumer protection. And why I sort of say this is, I'll come to that a little bit, but as much as I would really love to give you a scorecard as to how we've done this year, but that's pretty much impossible because a lot of these changes, as I said, will need some time to see whether or not they've had impact. If it's just a highlighting statement, I would have said no, because of the fact that we still see cash is the most prevailing, and it's almost that it's not even reduced. There's no trend of reduction in terms of cash usage and the preference for cash. So I would have to say that in some sense that they didn't measure up. The changes this year haven't measured up, but that is not to say that they will not have a latent impact. It could be the case that we see them a little bit more. And so how we sort of maybe should think about how policy is measured up is by using RBI's own metrics and sort of see whether or not there has been an increase in coverage. And this is something that we do want some more clarity on, to be something that's often being put up maybe in some sense like a disclosure, could sort of tell you whether or not there's been increased access. We do feel that there has been increase in the number of POS terminals, and that's something that since demonetization picked up, a number that I read somewhere was about 97% increase in the number of POS terminals in the last year, and that's immense. But we don't know about the participation and the use of those by consumers, and that's something that's important to sort of measure, to make sure that we are on the right track, and also to keep ourselves checked, right? In terms of convenience, we see a lot of movement. Again, the Bharat QR is one sort of move towards it. Interoperability is another. Confidence as well as cost are some things that are still being worked out. We don't know. The confidence does matter a lot in some sense. When we'd done a small, my colleagues had done a small sort of a qualitative study in rural areas to see whether or not adoption of mobile payments were picking up. And it's often seen the fact that some of the interviewees had said if transacting by mobile is probably one of the most dangerous things for them, because they often relate to it as fraud. And this was a really powerful statement, and about 50 interviewees, and all of them in some sense resonated the fact that digital payments was not as they did not feel secure in terms of using it. And this probably is an effort that has to be both from the regulator as well as from market, sort of improve the confidence in terms of getting new markets and new customer segments to start using digital payments. Then that there seems to be a lot of work that needs to be done on that. As I mentioned, cost, yes, we are going through the MDR regime. That's one of the biggest cost reduction factors that we've seen, but we don't know the efficacy of how it will turn out to be in the long run. Just to sort of end this is something that I'd already said. This it's not just the idea of of payments, and payments regulation is not just something of primal importance here, but it's also of importance to the entire sector. If you look at it, almost all products and all sort of services that are financial in nature are going through the payment network, and so in some sense we see it as the pipeline. Um, you see the movement towards ENPS, which is for a pension scheme. You see a lot of insurance providers now serving pension products online, um, and through apps, as well as using some of the UPI based, as well as other USSD based sort of payment modes to start working these products out to the larger market. So what I'm trying to say is that there is definitely an adjacency to a lot of other financial sectors, a lot of other financial institutions and other products that payments regulation does deal with. And in some sense, if we were to talk about larger financial inclusion and sort of getting in consumer segments that are not typically included already, it's something that, and this is why policy in this space might be of really important and could be of high value here. Sort of I'll stop there. I'm about 9 minutes. If there's any questions, I'm happy to take them now or offline.